Good afternoon, everyone. I am Ruturaj Bhide and I'm delighted to welcome you to this session. Today, we will be discussing an important compliance which is going to be applicable for most of the industry players with multiple GST registration. And we're talking about Input Service Distributor or ISD as it is commonly known. Most of you would be aware that ISD has become mandatory from 1st April 2025 and under the mandatory regime in the next week, there'll be the first ISD return that will have to be filed. So in this context, today we will be talking about an overview of the ISD mechanism. And more importantly, we will be covering practical points and key questions which come to anybody who's dealing with ISD mechanism. I'm joined by my colleagues Sangeeta and Arun, who will be sharing their practical insights on what are the key points and what are the key pitfalls to avoid when one is dealing with an ISD mechanism. Now, I'm sure many of you are aware or familiar with the concept of ISD, but for the benefit of all and in order to bring in the context, we will be spending some time to refresh about basic concept of ISD, the relevant provisions of ISD, and then we will get into a panel discussion wherein we will be talking about important areas that one has to be mindful of when we are dealing with ISD mechanism. Now, ISD is not really a new concept. Many of you would remember that even under the pre-GST regime, under the service tax law, we had the concept of ISD. And to simply put, ISD is basically an office of supplier of goods or services which receives invoices for services on behalf of the distinct persons. So to put a very simple example, let's say if I have a company with my head office in Mumbai and I have multiple branches in, let's say, Gujarat and Delhi. And if I receive any invoice on my Mumbai head office for, let's say, professional services like statutory audit or management consultancy services, now these services are not only used by the Mumbai head office or the Maharashtra registration. These services are also meant for other registration. It's basically for the entity as a whole. So in this situation, the ISD mechanism allows the Mumbai head office to distribute the input tax credit, which has come on this invoice to other locations, to other registrations. So ISD is a mechanism which allows me to distribute input tax credit among the multiple registration that I have as an organization. If we see the GST law, there are several legal provisions under the GST Act as well as GST rules which deal with and provide for the ISD mechanism in detail. So we have section 20, which lays down the foundation of ISD mechanism. We have section 24, which says that an ISD has to obtain a separate ISD registration mandatorily. Rule 39, which is the mother rule, I would say, which covers the entire procedural rules for how an ISD should distribute its credit. We have Rule 54 that talks about how ITC distribution should happen through issuance of an invoice. And finally, we have Rule 65, which talks about ISD return, which has to be filed. And the first mandatory return will have to be filed the next week on 13th. Now, let's discuss what has really changed, because like I mentioned, ISD is not a new concept. It has been there in the GST regime right from 1st July 2017. But what has changed now is that up until 1st April 2025, every organization had an option to how they want to distribute the input tax credit. Okay. We have seen among industry that there are several companies who had obtained ISD registration right from inception of GST, and they have been following the ISD mechanism since then. So for them, it's really no change. But at the same time, there were a number of players who did not opt for ISD as a way of distributing credit. Instead, they opted for something called as a cross-charge mechanism. Now, in case of a cross-charge mechanism, what happens is that my head office or any of the offices will receive an invoice for an input service which is meant for other registration also. The registration which has received this invoice will take input tax credit on that invoice and then distribute the credit by issuance of a cross-charge invoice. So rather than obtaining a separate ISD registration, number of companies were managing to allocate or distribute the common credits through a cross-charge route. Now, cross-charge route is not just meant for distribution of common credit. It also has other relevance, for example, cross-charge for internally generated services, etc. But we are going to be focusing only on the ISD or distribution credit portion. And therefore, up until 1st April 2025, an organization, or for that matter, every organization had an option of how they want to distribute their common input tax credit. After 1st April, what has happened is that it has become mandatory that if I'm receiving any input invoice, which is common in nature, which is for common services, I do not have an option of taking it in my regular registration and then doing a cross charge. I have to necessarily ensure that I have a separate ISD registration. I get those invoices billed out to my ISD registration, and then I do ISD distribution as has been specified in Rule 39. So this is the big change. So as a concept, ISD is not a new concept. Per se, there is no change in this concept. But importantly, the ISD mechanism has now become mandatory. So anyone with more than one GST registration will have to necessarily look at and consider ISD mechanism when it comes to distribution of input tax credit. Now, let's see how the input service is to be distributed as a part of ISD mechanism. Now, first of all the services which are common in nature will need to be distributed. Now here, on a case-to-case basis, the nature of common services and whether a service is common to all the registration or specific registration will vary. And that's something will have to be looked at on a case-to-case basis. But basically, all the common services which are being received, I have to ensure that I get those invoices in my ISD registration, and then I have to allocate or distribute that credit to relevant registration. So let's say if I have 5 GST registrations and I receive an input invoice for which is common across all the registration, then I will distribute that input tax credit across all the 5 registrations. Now, how do I decide what is the proportion in which I have to do the distribution? So the basis for distribution will be the turnover. So whatever is the turnover in the respective registration, uh, uh, in that proportion, I'll have to distribute the input tax credit on these common invoices. One very peculiar point which one has to note here is that it is mandatory and required under ISD that the ISD should distribute both eligible and ineligible credit. So as an ISD, if you receive any invoices on which the credit is not allowed by the GST law, nevertheless, the credit of that needs to be distributed among the relevant registrations. And then eventually the relevant registration will take credit of eligible items and will disallow credit of ineligible items. But as an ISD, I'm required to distribute credit of both eligible as well as ineligible ITC. Now, coming to the different components of GST, how those are to be distributed. Now, as an ISD, I can receive invoices from suppliers within the same state who will charge CGST and SGST on that invoice. Or I may also receive invoices from an interstate party with IGST. Now, how do I transfer the IGST credit or CGST, SGST credit? For that, there is explicit mechanism which has been provided in the rules. So if the ISD registration and the recipient registration to which input invoices or input credit needs to be transferred, then IGST will have to be transferred as IGST. CGST, SGST will be transferred as CGST, SGST itself. But if I have a situation where the ISD is based in one state and the registration to which the credit needs to be transferred is in a different state, then in that case, IGST will always continue to be distributed as IGST. but even the CGST, SGST, or for that matter, UTGST component will be transferred as IGST. So that's the mechanism in which the credit will have to be transferred. Now, coming to the compliance or added compliance, which the ISD framework brings along. Okay. Now, every ISD registration is required to file a monthly return. The return is called as GSTR 6. And this return is basically to distribute the credit among relevant registration. So if you look at the timelines, basically there is a stringent date which is getting added into your compliance calendars. So typically, let's say for the month of April, your vendor has raised an invoice or ISD registration. He will file his GSTR1 on 11th of May. On the basis of whatever invoices which have been reported in the GSTR1 of your vendors, there will be an auto-populated GSTR 6A, which will get generated on the 12th of May. So the way we have GSTR 2B, this is similar for the purposes of ISD. We will have an auto-populated GSTR 6A in which all the invoices which my vendors have raised on ISD invoice will get populated. So this is happening on the 12th of May. And immediately on the 13th of May, the very next day, you're required to file GSTR 6. And once you file GSTR 6, the relevant units or relevant registrations will receive input tax credit, and which can be used by them and availed by them in their GSTR 3B to be filed on the 20th. So if you look at it in terms of timelines, this is a more stringent return. While we are all used to filing GSTR 1s and 3Bs in a limited short time, GSTR 6 is in a way crunching that window, and we need to complete that compliance much faster or with relatively lesser time for doing that compliance. Let's take a minute to understand what is the component or what are the details that go into your GSTR 6, which is your ISD return. Now, typically, if you look at GSTR 6, firstly, all the inward detailed invoices. So invoices which have been raised on the ISD, which are there for distribution, those will have to be furnished as a part of your ISD return. Then the distribution of that among different registration will have to be furnished. And the form also allows me to provide some other details like late fees or redistribution, etc. Now, in terms of steps, first of all, if when I'm filing my GSTR 6, whatever is the base figure that I'm getting in my GSTR 6A, I will have to modify that, add to it, reduce from it, depending on the actual data available in the system. And on the basis of that, firstly, the ITC available for distribution will have to be crystallized. Once that is done, the ITC will have to be bifurcated into eligible credit and ineligible credit. As I was saying earlier, an ISD is mandated to distribute both eligible credit as well as ineligible credit. So both these credits will have to be distributed. At the back end, the organizations will have to work out the proportion in which input tax credit needs to be distributed across the registration. And on the basis of that proportion, the distribution will have to be recorded in the ISD return, and then we file that return. So that's really the step which we need to follow as a part of ISD registration. Now, I'm sure many of these things were something which you were aware of, but we wanted to cover it as a refresher for all the participants. Now that we have discussed the key concepts and framework of the ISD, now let's shift our gears and let's get into our panel discussion, wherein we will be covering relevant and topical points which are perhaps on everyone's mind when they're dealing with ISD mechanism. Now, first, I have a question for Sangeeta. This is really a foundational question. So, and I'm sure this question is there on the minds of many of our participants, that we know that ISD mechanism has become mandatory from the 1st of April. Having said that, it could be possible that many of the companies have not yet obtained ISD registration, or we can have a situation where vendors are still raising invoices on the regular registration instead of raising invoice on the ISD registration. So, Sangeeta, what can we say are the implications on such cases?
Yeah. And before I even get into the specific questions you asked, Ruturaj, like you said, ISDs become mandatory as of 1st April. So all companies with multi-state operations will need to obtain this ISD registrations, because even if one could argue that there are no common procurements, that's rarely the case. All companies with multi-state operations will have common procurements. Now coming to the point of what if, as on date, I've still not applied for the ISD registration, then the first step would be to apply for that registration. Because the ISD registration undergoes the same rigors in terms of verification process, etc., that a normal registration does. So there is a lead time that goes into obtaining this registration, submission of documents, and of course, this is through the GST portal itself. The first step would be to get the ISD registration in. And a subset of this step would be to assess your procurements to identify common procurements. And this would include analysis of, let's say, agreements, analysis of POs to see if there's any change required there. So those are broadly the two things that need to be done on an immediate basis if, as a company, you've not yet applied for the ISD registration. Now coming to the more complex issue of, let's say I've applied for an ISD registration, I've received an ISD registration, and where I've started vendor communications or I've not yet started it, whatever the case may be, and therefore my vendor invoices haven't flown into my ISD. They have continued raising their invoices on the regular ISD, regular registration in the state. In this situation, while, if you, and again, I need to recap a little bit on, 54(1)(a). You did briefly cover it in the introduction slides. So 54(1)(a) is a concept where, let's say a vendor raises an invoice on a regular registration. The GST law allowed such credits to be transferred to ISD and then distributed. However, there's a catch here. The whole reason for 54(1)(a) to be introduced under the GST law was because the ISD registration by itself could not make RCM payments. The whole reason 54(1)(a) was introduced, even if you see the GST Council minutes, was exactly this. And very recently, that is in the budget, they made an amendment when they replaced Rule 39 with the revised rules, to be made effective April 1st. The rule effectively says that 54(1)(a) can only be used for RCM cases, which then leaves companies with just one option. That is, if the invoice has been raised to the regular registration, you go back to your vendors, request them to raise a credit note, give them the ISD registration number. If already obtained, then that number. If not, then once it's obtained, you'll have to pass it on to the vendors and then ensure that the invoice flows to the ISD mechanism. So these are broadly, step 1 and 2 to get ISD ready, and then the transition aspect that you asked.
Yeah, I think, Sangeeta, what you mentioned about vendor communications is absolutely the key, I think, here, that everyone who is obtaining ISD registration, it is very critical for them to communicate to all the vendors who are raising typically the common type of service invoices, that henceforth the invoices need to be raised on the ISD registration, so that such scenarios of inadvertent invoicing on the regular registration doesn't happen. Yeah. Okay, moving to one more question which we commonly get. We're hearing a lot from many of the clients, and this is my question to Arun, is that we often get asked this question, is that whether the provisions of 16(2)AA of the CGST Act and Rule 36(4), which basically require matching of ITC with auto-populated data, can we say that this is also applicable to ISD? And or say differently, if I am a ISD, which I have, if I have an invoice but it has not populated in my GSTR 6A, will I be right in distributing that credit? That's really the question.
Okay, thanks so that's for asking. I think you rightly pointed out that this is one of the most after-sought questions of ISD till date, at least for the new registrations. We're going to file their first return on the next week. So, and I also tell you the background why this question is being asked so much. So, for the past 3-4 years, we have become accustomed to reconciliations. Any ITC that we claim in the returns, we have to match it. And that is because of the reasons, because in January 2022, there was an amendment in section 16 to say that any ITC that is to be claimed, it has to match and has to appear on GSTR 2B. So that is why this comes again and again. Now, coming to this question, it's an interesting one. So I'll cover both aspects of it, one being legal and the other being practically for the obvious reasons. So legally, if you see, the only provision under GST which talks about matching of ITs is section 16 to AA and the related rules. Now, this provision simply says that any invoice which is appearing in form GSTR 2B can be claimed as an ITC in GST returns. Now, interestingly, this does not cover for GSTR 6A. That means technically, under GST, there is no provision that restricts distribution of ITC by an ISD if it is not appearing in form GSTR 6A. So to answer your question, even if an invoice is not coming out in form GSTR 6A, legally we can claim, or ISD can adopt a position to claim that credit in GSTR 6A and 6 and distribute it. Now, coming to the practical aspect of it, now as the people are accustomed to the reconciliation, GST department has also been adopting a very stringent position since the beginning, even before this provision came into light, that any ITC that is to be taken into the GST return has to be appearing in the recipient's GST portal. So in case any invoice is not there in GST 6A, and ISD distributes it. So for sure, department during the assessment or scrutiny will raise this issue and start the proceeding about issuing notices and show cause and so on. So even though legally ISD can distribute the credit, but practically they should not be, to avoid all the challenges that that the department may come up with.
Right, right, absolutely. Continuing on the same, lines, another question which comes up is that, okay, in a way, it's a corollary situation that, let's say, if I have an invoice in my GSTR 6A, but I have not yet booked it, I have not possibly received that invoice. So, the question is that Rule 39, if we look at it, it says that ITC shall be distributed in the month in which it becomes available for distribution. So does it mean that I have to mandatorily distribute ITC on an invoice which is appearing in my 6A, even if it is not recorded in my books? Is that how we read it?
So to answer, I'll just try to cover up where this came from. So the term that is there available for distribution. So Rule 39 simply says, as you pointed out, any ITC which becomes available for distribution has to be distributed in the same month. Now the question rises, when does an IT become available for distribution? So this term becoming available for distribution is not coming out of is not being defined either in section 20, which is the ISD provision, or under Rule 39. So this specific verse is coming from the GST ISD return, which is from GST 6. So as you pointed out, the key table in ISD return is table 3, wherein you put the invoices which are going to be distributed. And the invoices, whatever invoices you put in table 3 are becoming available for distribution the GST returns. So that means if an invoice for that matter is raised in April, for the month of April 2025, and is appearing in GST 6 of April 2025, if you add that invoice in table 3 of April, it will become available for distribution the month of April itself. However, if you don't do it, if you delay it and add that invoice in table 3 of June GST return, then that ITC will become available for distribution the month of June.
Right.
So summarizing it up, it is up to you. The invoice in the month in which you show that invoice for distribution, only in that month it becomes available for distribution. So there is a possibility that there can be a gap between the date of invoice and the date on which you're distributing the ITC. And that gap is totally up to you. If you're filing a return and adding that invoice in table 3, within that month it will become available for distribution.
Right. Okay. So basically, we are saying that once an invoice has appeared in my GSTR 6, it's basically the tax recipient is the recipient's call. If the invoice booking hasn't yet happened, the recipient can very much hold that invoice and not report it in table 3. And the reporting in table 3 can happen if as and when the booking happens or other processes are completed, so long as I'm falling within the permissible timelines of availment of credit.
Correct. And to add on, the meaning ultimately for this provision is as soon as you put that invoice in the table of becoming available for distribution, in the same month you'll have to distribute it. That's
Right.
it.
Right. So I think one will be more careful. Just because I'm seeing something in GSTR 6A doesn't mean it has to automatically travel to table 3. I'll have
Correct.
to sort of have a reconciliation with my books and then decide what goes in my table 3.
Right.
Okay, all right. The next question, I think, and this is something I would say an intriguing question, and this is something which I have for Sangeeta, is again a timeline related issue. Now, if we see the whole scheme of things of ISD, like I was mentioning, let's say there is a invoice raised in April by my vendor. The vendor filed his GSTR 1 in May 11. It appeared in my GSTR 6A in 12th of May. And now on 13th of May, I'm supposed to distribute this credit. So the question here is that what is the right point when I A, raise a distribution invoice, and B, which month should I really consider a particular invoice for the purposes of distribution? So, this is one very peculiar question pertaining to timelines.
Yeah, and I mean, like you said, I think the timeline provided for reconciliation is extremely short for the ISD registration, given that the due date sits on 13th. But and this is a practical challenge we've been facing for all of our clients as we've progressed into implementation. Now, going, based on the example you've given, let's say if there are invoices for April now, all of these will reflect only on the 12th. My return is due on the 13th. And I can only decide on the distribution once I've looked at my 6A, vetted those invoices flowing in and credit flowing in, and determined how to distribute it. Now, there are two ways. I mean, one, and I'll tell you, as we've implemented, there is a practical approach that's being adopted. And then there is the second, which perhaps appears more legal, but then again, it's also a lacuna in the system itself. So one way, and a large company, a good number of companies are doing this approach, wherein you reconcile the invoices once they appear in 6A on 12th and issue the invoice dated April itself. The reason companies are able to do this is because ISD invoices are generally they don't flow through the ERP like a typical supply or a tax invoice, right? So it is, while yes, it is still forming part of my records and books of accounts, it doesn't flow through the ERP, and therefore I'm not limited by, it's not as if I'm trying to put in an invoice for the previous month. So companies are able to adopt this practical approach. But a good number of others who maintain, let's say, separate separate credit ledgers for each state and would like these invoices to flow through the ERP. Unfortunately, such companies are forced to defer, credit availment by a month, because what happens is the distribution happens only in the month of May when the return is due. And if the invoice is dated May, then you're effectively deferring credit availment by a month. It's not a perfect mechanism. It's not the perfect solution that companies would be looking for. Perhaps we'll see a better solution maybe, the board will also look into this. But as of now, these are the two options available, and there are companies adopting both approaches.
Okay. So one way is that there could be a complete 1 month's lag in your availment of credit, or you are able to, if you already booked these invoices and on the basis of that, you are able to raise an invoice dated April, then that's how you basically take it forward and ensure that the credit flows into the month of in the GSTR 6 of April itself.
Correct.
All right. Sangeeta, continuing with you, very simply, we first say that, okay, ISD mechanism is meant for distribution of common credit. And, it's very said out very simply, but, we've seen that this becomes a, point of contention, point of confusion for many entities as to how do I decide that what is common, and how do I decide that what is common across all the entities, all the registrations, some registrations. So, what is it that organization could do to approach and identify what is the common expenditure?
This is such a vast topic in itself. And I don't think this session would even do justice to the number of practical scenarios we've all faced together. But having said that, it's difficult to define what common is for companies, because it differs basis sector, it differs, and it's very, very subjective. And that is why we haven't seen guidelines on how do you determine common credits. It's very challenging to bucket or provide, step 1, step 2, step 3 in identification of common credits. It's almost impossible. And that even if we do have broad guidelines in the future, it will continue to be a subjective topic. You will have to determine what is common for you and for the company basis, specific facts, again, going back to agreement, POs, and actual service rendering itself. So it will have to be basis underlying facts. But having said that, I think it's so important at this juncture that we are, where we are filing the first ISD return, to perhaps give some broad guidelines based on our practical experience on what is common, what are the potential categories of common expenditure, and then what is not. And we've listed a few on the slide, right? Statutory audit fees and ERP license. These are typical examples given when we talk about ISD. These are services procured by a head office, but where the benefit accrues to all units or all GSTINs within the entity. Marketing expenses honestly can be a bit of both. You could have marketing expenses that are, yes, generic to the company and should be routed through ISD, but you could also have marketing expenses for specific revenue streams, products, service lines, whatever the case may be. So marketing expenses, while in a very generally speaking, while one could say yes, it should flow through ISD, I would urge everyone in the audience to review such credits very carefully, review underlying documentation, and only then determine whether it needs to flow through ISD or not. And even within the ISD mechanism, we've discussed it briefly, if the marketing expenses pertain to only a few locations, an ad in a regional newspaper, if it pertains to that particular region, the benefit accrues to those branch offices, then you should be distributing it to only those states. And making it a little more complex is, let's say, the rent of a corporate office. What companies need to decide is if such services, are they consumed by the head office in performing their activities? So the head office typically houses your HR, your IT, legal, etc. So the rent that you pay for that office, is it consumed by these divisions which are producing internally generated services? Or is it really common? Again, very case specific, very subjective. But for rent, for facility maintenance, for those kind of credits, one needs to evaluate whether it is consumed by the head office or is it procuring it for and on behalf of other GSTINs. So this is broadly it. We haven't even touched the tip of the iceberg on this topic. It's very complex. The larger the business and larger the complexities, the topic of common credit also gets very, very challenging. But I'm hoping that this at least has given some indicative guidance on how to go about this topic.
Absolutely. Sangeeta, as you rightly said, it is very subjective. So just one connected question. Do you see merit in sort of organization documenting their rationale? So because for every organization, it will be peculiar as to something is common, something is not. So is there merit? And in fact, have you seen organizations or that document sort of documenting this whole rationale, which can become a basis for them to even justify this logic if required?
No, and it's important on so many levels, just for business continuity in some cases, because you'll have people in the tax team that change over time. Second reason could be that you might have the same vendor providing different types of services. You could have one vendor that provides common as well as exclusive services. And even if you go back in time when we implemented GST, there were MOUs put in place. Most people, put MOUs in place for the so-called internally generated services and their reason for cross-charging or not cross-charging and the valuation and how they went about it. Very, very critical and a really good suggestion, Rutraj. I think that's absolutely necessary in this situation.
Sure. Okay, thank you. Moving on now, one thing which we know is that an ISD registration per se doesn't have ability to make any liability payment. So if I am importing a service which happens to be common in nature and it triggers an RCM liability, I won't be able to pay it through ISD mechanism. So this brings me to my next question for Arun, is that, how is entity which are receiving services under RCM and which are common in nature, how should they go about the ISD distribution? What is the mechanism that has been prescribed for RCM liability credit distribution?
Sure. So this mechanism has been provided under the provisions of the ISD, which is Section 20, Rule 39. Surprisingly, earlier to the 1st of April, this provision did not contain anything about the transfer. However, the rule which provides for ITC transfer document was there. Now, from 1st of April, the provision itself caters this situation and says that in case there's a reverse charge payment that needs to be done, it will be distributed through ISD, number one. So it is mandatory for the taxpayer to avail and distribute ITC, which is under RCM. Now, the process contains 3 steps. So firstly, to pay this tax, there has to be a GST, regular GST registration in the same state wherein ISD registration is taken. So the first step contains the payment of reverse charge by the regular registration. So the regular registration, the same set will take the ISD, take the reverse charge invoice, pay GST, claim the credit, and then issue a ITC transfer document to ISD. So the second step contains issuance of that document which transfers the ITC to the ISD for further distribution. So this the content of this document is already there in 51A, and this specifically contains the invoice number, details, GSTN of the supplier's invoice. So in case, let's say ABC and company issued an invoice on which tax is payable under RCM, and they issued this invoice to the regular registration. Now, regular registration will pay the GST and then issue a credit transfer document to ISD. This credit transfer document will contain the invoice detail of ABC and company also, to substantiate that this was the ITC, this was a services which I received invoice for and paid GST, and now I'm transferring the ITC. Then comes the third step. ISD will take that invoice as a normal routine for distribution in one invoice, and then distribute the credit which is mentioned on the credit transfer document to the recipients. So this process has to be maintained for all the reverse charge payments that are being made by the regular GST registrations.
Okay. So one connected question, Arun, is that, so what I understand is that regular registration will pay the tax under reverse charge and then issue an invoice to distribute that to ISD. So this invoice that we're talking about under Rule 54(1)(a), and if I am covered under e-invoicing as a taxpayer, then even my Rule 54(1)(a) invoices will have to have e-invoice IRN generated, or how does that happen?
So this becomes a little complicated one. While the law has provided the mechanism for payment and distribution in case of reverse charge ITC, there is one issue that remained: how to report that invoice first, and then whether that invoice will have IRN or not. Now, to answer the IRN question, I'll just brief you about the reporting first. So firstly, this credit transfer document has to be reported in the GST returns. However, there is no specific table in the GST returns wherein you can report such invoice. So the only option that you have left is to report this invoice as a supply document. So like you mentioned, you report your B2B supply document regularly in GST 1 and 3P, you'll have to report this credit transfer document also in a similar fashion. Now, even though this document is a credit ITC transfer document, it takes a nature of a supply. However, this does not change the fact that this invoice is not for a supply. And coming to IRN provisions, IRN is only required to mention the invoice which is issued for supply of goods and services. So since this document is not for supply, there will not be any IRN legally on this. There is no requirement for this.
Okay. So no clear, no black and white answer really on this. It will depend on, how conservative one wants to be. Fine. The next question again I have in relation to this Rule 54(1)(a). Sangeeta, if you can just share some insights on this. So, I mean, while I understood that Rule 54(1)(a) is meant for distributing the RCM related credit, but going back to the point that we talked earlier, that if I have, let's say, received invoice on my regular registration instead of ISD, and therefore I have got a credit, is it possible that I somehow use this rule 54(1)(a) invoice and transfer this credit also to my ISD the way I'm doing my RCM transfer? Is that possible?
You know, the intent of this credit transfer mechanism under 54(1)(a) was very clear. It was because when ISD got introduced, there was no mechanism to make RCM payments. And I think that this has been pretty clear. However, because the law did not restrict you, from using 54(1)(a) for any other invoice, the wordings of 54(1)(a) did not restrict you in using this credit transfer mechanism for even non-RCM cases. Companies would use this, have been using this, and there were no questions raised either. However, with the recent amendment and the language that has been, employed, which is that it is restricted to RCM cases, I don't see this as a possibility any longer. Past cases where this has been used, I think the position is defendable. I don't think there's anything in the law that restricts it. However, going forward, 54(1)(a) will need to be restricted to RCM cases.
Understood. Okay, the next question I have is about manner of distribution. So if we see the rule 39, it very clearly says that I have to use my turnover of previous financial year as a basis for distribution of credit. Now, Arun, can you share some thoughts that I may have a situation where I am a newly started business, or let's say if I start one of my registration and it doesn't have any turnover in the previous period. So how do you go about distribution of credit in these situations? And I'm sure these are not very uncommon. I'm sure many of the companies would have this kind of a mix that they don't have turnover as a basis. So does that become a roadblock, or is there any way out of this situation?
So Dhruva, this situation has been there since the beginning of ISD, and surprisingly, there has been no clarification with respect to that. So, as you rightly pointed out, the distribution of ITC under ISD has to be done in the ratio of previous year's turnover. And there is again a second option to it, that if the previous year turnover is not available, then you can apply the last quarter's turnover. However, they missed out to point out, in case there's a new entity and even in the last quarter also there is no turnover, it is the first month itself, then what is to be done? And it has yet to be clarified. Since it is yet to be clarified, the industry as well as the consultant have waved out a way to distribute the ITC, because there has to be some ratio at least. So practically what people have started doing is, in the first 3 months, because after first 3 months there will be a last quarter turnover already available. So during that interim period of first 3 months, they distribute the credit in the same month's turnover ratio. So for example, April 2025 is the first month of the company, and they have obtained an ISD registration as well. So on the 30th day, they will fetch out the turnover for all the states and distribute the ISD credit in the same month's turnover. And they do it for the first 3 months. From the fourth month, since they already have last quarter's turnover, then they do it on the basis of last quarter's turnover. So since there is no way out legally, that is the only possible option that the taxpayers have right now.
Okay. Sangeeta, have you also seen something similar in terms of practical way outs which people have found out to deal with this situation?
Yeah, and like Arun pointed out, this lacuna has been there since the beginning. The law could have very well set basis the last month's turnover, but it doesn't. It refers to a quarter. So this practical approach is what we've seen companies doing.
Understood. Now, continuing with Sangeeta again. So another question I have, and this would be relevant for anyone who's newly going in for a ISD, and for people who are filing ISD return for the first time. It's very much possible that I have gone wrong in terms of my distribution. So it could be that my ratio has gone wrong, or I have distributed credit to not correct number of GST registrations, etc. So what happens in this situation? Do I have any way out? Is there any way that an incorrect distribution can be rectified at a later stage?
So like the ISD is allowed to issue an invoice for distribution, there are also mechanisms which allow the ISD registration to raise credit notes and subsequent debit notes as well. So if a taxpayer ascertains that the distribution, that the ISD registration has undertaken for a past period is incorrect and that needs to be revised, then a credit note can be issued. The credit note needs to be issued in the same ratio as the original distribution itself, because that's how the set-off happens to the recipient units. And subsequently, a debit note can be issued for the redistribution of credit. So this mechanism is very much there in the law, is a part of Rule 39, and this is how companies can also accommodate errors and any changes that need to be made to the distribution itself.
I'm sure this is a comforting position for many of the entities who are going in for ISD return for the first time, that even if you've gone wrong, even if there is some mistake which happens in the distribution, there is enough and more room to rectify it in future.
Correct.
Okay. Another question, and I think this is very, very important and rather complex for handling administratively, is that today when I take credit in my regular registration, I'm aware that okay, I have crossed 180 days, I have not made payment to my vendors, and I'm required to reverse that credit temporarily, etc. So, all these section 16(4) related conditions, Arun, one question comes up is that in case of an ISD mechanism, how does it happen? Who is responsible to sort of take charge and make sure that the credit is set right, it's reversed appropriately at right point in time, reclaimed? How does this happen in an ISD setup?
So this has been again one of the most asked questions, because in this case there has been two points wherein ITC has been received. One is the ISD level, then comes the recipient level. So the issue always remains which one to check all the conditions. Now to firstly understand all of this, we'll have to see what is the location or the GST which avails the credit first, because unless a credit is availed by location, there cannot be any repercussion of reversal. So if you see GST law, it has very clearly mentioned that ITC availment will only happen when it is in the returns and then gets transferred to the electronic credit ledger.
Right.
Unless it goes to the ECL, you can't say that ITC has been claimed. And for that matter, ISD does not have an ECL. ISD is merely a conduit. It receives the credit and distributes it in the ratio. It never just keeps on adding it to its own kitty. It has no kitty per se. So since the ITC has been availed at the end of recipient locations, then the reversals or the repercussions will always have to be the recipient ends only. So in case there is a non-compliance with 180 days or non-payment by the suppliers, the recipient locations, not the ISD, will have to reverse the credit. That is very clear. Now, the second question in which that arises is, now it is clear that the recipient will do the reversal. How will that process be? Will it be through ISD or will it be a direct reversal? So it has both of these options. The very first option is a hyper technical one, wherein since ISD has to distribute a credit by bifurcated into eligible and ineligible credit, and the condition of 180 days makes an ITC ineligible. So in case ISD has distributed a credit and after 6-7 months, since there was no payment of consideration became ineligible, ISD should uh, change or rectify that credit by issuing a credit note first and then issuing a debit note by making it ineligible. And when the payment is made, then you'll have to do the vice versa process to make it eligible distribution. That is the first way to do it. However, that in itself has own challenges because the credit note ratio is different, debit note ratio is different. Now there comes the second option to it, which is a simpler one, but still has some complexities to it. The second option is the recipient locations by themselves reverse the credit in the GST returns. Now for that, all the recipient location must have the information on whether there is a payment being made within 180 days or not, which may or may not be possible in many scenarios. So the reversal has to be done at the recipient levels, but there are two processes to it, and you'll have to decide based on the company scenario how the structures are, how the details are going to be spread out. So basis that, the reversal mechanisms can be found out either through ISD or directly by the recipient locations.
Understood. So as long as the end goal of reversal of credit is met, you could opt for either of the ways which sort of fits into your administrative setup. Fair enough. The next question, and I'm sure this will be bothering many of the newly ISD registered entities. So, Sangeeta, one question which I have is that can we say that all this ISD distribution, the returns that have been filed by ISD, can we say that these can be selected for, let's say, GST audit, or have we seen that authorities sort of review that or scrutinize the way in which allocation under ITC is happening? And more so that now that it has become mandatory, do you see that it's more likely than not?
No, I think the answer to the first one is a simple one, that an ISD registration is just a different type of registration. But I mean, for as far as the GST law is concerned, it treats it like any other GST registration. And therefore, yes, it will undergo an audit. However, the question could be how is it that we've not seen a lot of ISD registrations undergoing audits? And the answer, I think, lies in what you just mentioned, Ruturaj, that it wasn't mandatory until today. There were fewer companies, I'm not saying they weren't, but there were fewer companies that had actually implemented, the ISD mechanism. And therefore, perhaps we've not heard of too many such audits. However, practically for cases where some of, companies that I've interacted with have had ISD registrations in the past, the audit has been undertaken concurrently along with the regular registration in the state. But I think going forward, there is a possibility and a high chance that there will be a separate audit for ISD, because there needs to be a higher rigor and examination of how the credits have been distributed. And going back to the topic of whether the credits that have been distributed are common, have they been distributed accurately? So I think we will see audits for ISD going forward in a more streamlined and rigorous manner.
And just one thing to add, within this audit itself, since ISD in itself does not avail any credit, it only passes the credit. Even if there are some discrepancies, then where this notice or demand is going to be? Is it ISD or the recipient locations? That will also be interesting to see.
Yeah, but I think one point then I pick up from what Sangeeta said is that it's very important for any entity setting up ISD mechanism to get the things right in first go itself, because we can very much be assessed, we can be scrutinized in terms of how I'm distributing credit. So it's very much relevant that I have the mechanism set right in the first place as we enter the ISD mechanism. Now, again, coming back to you, Sangeeta, I have one question. So now that ISD is mandatory, and I have to necessarily distribute all the credits through ISD, does it mean that the whole cross-charge mechanism is now over, or do you feel that cross-charge will still continue to operate in some way or the other?
I think both the concepts have always existed, Rudraj. Like you spoke about ISD, but even cross-charge. Entry 2 of Schedule 1 has always been there, which is effectively governing distinct supplies or supplies, between distinct persons. While ISD will get implemented for distribution of common input services, I think cross-charge as a concept will remain. For example, for situations where there are internally generated services, right? Again, very case specific and will depend on how entities are structured. However, the law continues to be the same, and it does recognize both cross-charge as well as ISD. And it's a very commonly asked question, but yes, the answer is that both concepts do exist and they will continue to coexist.
All right. The next question I have is, I could have a entity with, let's say, 5 GST registration, 5 regular registration across 5 states. So Arun, is it necessary that I obtain ISD registration in all the states of operation, or that's not something what the law has prescribed?
So the law simply says that any office which receives input services invoices for the distinct person for the other locations has to be registered as an ISD. So if there are 5 locations and 1 or 2 of them, generally it is one of them only being the HO or the corporate office, and that generally receives the common services on behalf of all the other locations. So that is on that location only is required to get registered. However, If there's a company and there are two HOs wherein there are two locations and both being the center and availing services for on behalf of all the other locations, then they both may have to get registered under ISD.
Okay.
And apart from that, there could be scenarios wherein there is one corporate office and within that there are divisional corporate offices as well. If the divisional corporate offices are also claiming or being an office of for center and claiming receiving services for on behalf of all the other locations under their division only, they may also have to get registered under GST. So it is up to your procurement structure only. If you centralize a single office and say that this is the only office which receives the common services, only that single location will be required to get ISD. But if there are more such locations, they may also be required to get the registration done at ISD.
Right. So I think basically what we're saying is that just because I have X number of registrations in X number of states doesn't mean I obtain so many ISD registration. The
Right.
optimal number of ISD registration will depend on my particular procurement mix, and I have to typically go for the optimal number of ISD registration.
Right.
All right. Okay. Coming to the last question of the panel, and again, I'll continue with you, Arun. So, this ISD invoice which we raise for distribution, or for that matter, the debit note or credit note which we raise for rectifying the distribution, for any entity which is mandated to have a e-invoicing, is it required that all these invoices, debit note, credit note should also have IRN on it?
So in the notification, the rule which is there for mandatory, which makes the IRN mandatory, it says that invoices issued for supply of goods and services only will have to get the IRN mentioned on the same. And the ISD invoices or debit credit notes are merely for distribution or rectification of such distribution and have no linkage with the supply of goods or services.
Okay.
So whenever there's an ISD invoice, debit or credit note, there will not be any requirement for IRN on that.
Understood. Okay. All right. Thank you, Sangeeta. Thank you, Arun, for your insights. Now we have a lot of questions that I can see in the chat box, and what we'll do is we'll try to cover as many questions as we can, and what we can assure to the rest of the participants is that if we are not able to take any of your questions because of time availability, we will reach out to you. We'll reply to you through an email. So be rest assured that your queries will be answered. The first question that I'd like to take is, and this is something which in a way expected that this question will come. So we have a question saying that, is it okay if I don't take ISD registration and I get separate bills from supplier, GST and wise for a common service? Sangeeta, would you like to take that?
Yeah, I could, and it's connected with what we discussed in one of our questions. It is possible, like I said, planning procurement of common services is very, very subjective and case specific. It is possible, theoretically, it is possible to not get an ISD registration if you're able to get split invoices for all types of common services. So the answer is yes. However, I would caution that it's very unlikely that all common service providers would be able to give you split invoices. And then again, how will they split these invoices? Will you provide the turnover for them to split these? There are a lot of practical challenges in implementing this. However, it's possible. Theoretically, it's possible.
Okay. Okay. The next question, I think, Arun, you could take this. So the question is that if I have, just because I have multiple GST registration, does it mean that I have to take, ISD registration? So the question I'll read out, it says that if I have multiple branch or multiple operations in multiple states, but other branches are acting only as back office without any turnover, then also am I required to obtain ISD registration? Because in that case, the turnover of all other registrations will be nil, and eventually everything will come down to the central registration. So in this fact matrix, does it make sense to obtain an ISD registration?
So this question would have a two-faced answer. One is a legal one, then comes a practical one. The taking a registration, requirement to take a registration, and then the distribution, both are separately prescribed under the law. Taking a registration simply says if there is a location which receives services for more than one locations, then it has to be registered as an ISD. So since in this case you have more than one location and you would surely be taking some services, for example, IT or some other HR services for both of these locations, then the registration will arise to that. However, even after taking the registration, the distribution may not happen to such location because the distribution is in the ratio of turnover. So legally, technically saying, you'll have to take the registration even though the distribution is nil to that location, to the sales office.
Understood. Okay. The next question is also, I think, something we sort of anticipated. So question is about IMS. And the question is that how do you comply with IMS credit notes in case of vendors which issue invoices or credit notes on a ISD registration? So any thoughts, any one of you?
So firstly, IMS, as of now on ISD, it is not there.
Right.
If you are filing an ISD registration, you are not bound to, anyways, it is optional, but for optional sense also, it is not there for, it is not even available for ISD as of now. However, coming to the second part of it, if there is a credit note, what is to be done? So if there is a credit note issued by the supplier on ISD, then ISD will have to issue another credit note to the recipients to reduce the credit in relation to that credit note. And remember that for this credit note to be issued to the recipient locations, ISD will have to take the same ratio in which ISD distributed credit of the original tax invoice issued by the supplier.
Right. Okay. Next question, I think, this I'd like to direct to Sangeeta. The question is on services which are received. The question is whether the services which are received from related party, will it fall under the scope of ISD? And if not, what is the legal backing for it?
Again, I mean, if we're referring to related parties with separate PANs, for sure. I mean, any service provided them, if it qualifies as common, will be routed through ISD. I don't know if the related party question is with respect to distinct supplies. But then again, distinct supplies, by and large, you would do it for stock transfer. So maybe some more details on the questions would help, but broad answer is that yes, related party transactions would also be covered under ISD.
In fact, what we could say is that whether it's related party or not, the basis for me to decide whether it falls under the ISD scope is the nature of service provided. If it is common, then it will be under ISD purview for irrespective of relationship. Okay, I'm coming to the next question that what if invoice available in GSTR 6A but not in books? Do I still have to bifurcate ITC of those invoices? I think we've already covered it, but maybe if you just want to briefly answer this question.
Sure. So to give a small answer to that, if it is not appearing into it, technically, legally, you can distribute that credit. But in that case, department may issue notices for some differences in GST 6A versus the distribution that you've done, and they may issue notice to that extent. So if you want to go conservatively, then you should wait till the invoice comes up with the GST 6A and then distribute the ITC.
Right. Next is again very practical and very important question from the SEZ fraternity. Sangeeta, maybe you can answer this. So the question is that ISD registration for SEZ entity, whether earlier vendors were issuing invoices at a zero rate. Now, can these zero rate invoices be raised on ISD registration of SEZ entity as well? And if not, it will have a working capital impact on SEZs because they'll be now there'll be credit which will flow into the SEZ. So, any thoughts on this?
No, I mean, so a SEZ registration is linked to the authorized license obtained by the unit. And that is why Section 16 allows supplies to SEZs to be zero rated, and it links it to the utilization of procurements to authorized operations as well. Now, ISD by sheer nature is procuring common services which are used by multiple units, which could be a combination of SEZ and DTA. So no invoice to an ISD per se cannot be zero rated. And this is a challenge. This is a practical challenge and a lacuna in the law. Once an ISD is deemed required or necessary in the fact pattern of a company, where there are SEZ units, the distribution will need to be undertaken to such SEZ units if it is a common service used by all recipients. And then, yes, there is a working capital impact. This issue has in fact been flagged to the board. And in terms of overall, legal structure itself on how refunds operate for SEZ entities, I believe that there is some discussion around that. So that should resolve this debate and issue of working capital when an ISD distributes credit to an SEZ unit. However, as things stand, there is a problem, and there will be a working capital impact to that extent.
Okay. Okay, now there is, there are number of questions which are there and which are coming in, but in the interest of time, can we take maybe 2 more questions, and then the balance, like I said, we could answer those over an email or a blog.
Sure.
So, because what I'm seeing is that many of the questions are also repetitive. But I'll still take maybe a couple of questions. So one question is, and I'm sure that's bothering many people, that's why I'm seeing that in repeat, is that can we avail ITC if vendor has raised invoice on a regular GSTN and not ISD? I think Sangeeta, you covered it, but maybe you just want to give a capsule, brief once again.
No, with ISD becoming mandatory and with the revised rule in place, common services need to be routed through ISD alone. The credit transfer mechanism under 54(1)(a) cannot be used to transfer, credits in case the vendor has issued the invoice in the regular registration to ISD and then distribute. For such cases, you will need to reach out to your vendors for issuance of a credit note and request them to reissue the invoice to the ISD. So we covered that, I think, but this is the way forward on this topic.
Okay. I think we'll just take one last question. This, I think, Arun, you can take it up. So the question is about, so we talked about what happens if invoice is there in 6A but not in my books. This question is sort of a reverse situation where the question is that if distributable ITC is booked in my books of accounts for April 25, but it appears in my GSTR 6A only in the month of May, then how do I go about the distribution? Should I distribute it in April itself, or should I defer the distribution?
Legally, I can distribute in the month of April, but I should wait for the month of May and then distribute it.
Correct. Okay. All right. I think that's it. We've already sort of overrun the time. So thank you everyone for so many questions and for making this session interactive. We will try and revert to your queries, whichever we're not able to answer during the webinar. We'll reach out to you through emails. So thank you very much for joining, and we look forward to seeing you in our next session as well. Thank you.
Thank you.